Imagine buying something for $5,000. Maybe it's a laptop, maybe furniture, maybe a few months of expenses. Now imagine paying for that purchase for the next 18 years. And by the time you're finally done paying it off, you've paid more than $11,000. You didn't borrow $11,000. You borrowed $5,000. And the reason this happens is something almost nobody talks about. It's called minimum payments. Every credit card statement shows a number called the minimum payment. It looks small, manageable. Maybe it says minimum payment $150. And when people see that number, they feel relieved. Okay, I can afford that. But here's the uncomfortable truth. Minimum payments are not designed to help you escape debt. They're designed to make the debt feel manageable enough to keep forever. Because when you only pay the minimum, most of your payment isn't actually reducing the debt. It's paying the interest. And the balance barely moves. Let's look at a simple example. You have a $5,000 credit card balance. Your card charges 22% interest. Your statement says the minimum payment is about $150 per month. That sounds reasonable. But here's what that payment really looks like. Out of that $150 payment, around $110 goes to interest. Only about $40 reduces the actual debt. So after 1 month of paying, your $5,000 balance becomes roughly $4,960. You paid $150, and your debt barely changed. Now imagine repeating this process month after month, year after year. At this pace, it can take nearly 18 years to eliminate the debt. And over that time, you'll pay more than $6,000 in interest, which means that $5,000 purchase ends up costing over $11,000, all because you trusted the minimum payment. Credit card companies aren't hoping you pay the minimum once. They're hoping you pay the minimum for years. Because the longer the debt exists, the more interest they collect. Minimum payments are carefully designed to hit a psychological sweet spot. They're small enough to feel safe, but large enough to keep the interest flowing. And for most people, that small number creates a dangerous illusion. It makes the debt feel like a monthly bill instead of what it really is, a long-term financial weight quietly growing in the background. The real danger begins when life keeps moving. Because while you're paying the minimum, you're probably still using the card. Groceries, gas, unexpected expenses. Each new charge adds more balance, and that new balance creates more interest, which makes the minimum payment slowly rise. And suddenly the debt isn't shrinking anymore. It's expanding. This is how people get trapped in debt cycles that last decades. Not because they're irresponsible, but because the system is designed to move very slowly in one direction, toward more interest. Most people hear about compound interest as a good thing, the idea that money can grow exponentially when you invest it. But compound interest works both ways. When you carry high-interest debt, compound interest is working against you. Instead of your money growing, your debt is growing. And every month you delay attacking the balance, the math gets slightly worse. Quietly, relentlessly. So what's the alternative? The simple rule many investors follow is this. If your debt interest rate is higher than what you can reasonably earn investing, paying off the debt is the best financial move. For many credit cards, that interest rate is 20% or more, which means eliminating that debt is like earning a guaranteed 20% return. And in the world of finance, that kind of return is extremely rare. The moment you stop paying only the minimum, the math finally begins working for you instead of against you. Minimum payments aren't freedom. They're more like a slow subscription to debt. They keep the balance alive just long enough for interest to quietly multiply. But the moment you understand the math, you stop playing the game the same way. Because escaping debt isn't about making the minimum. It's about breaking the cycle entirely. If this video helped you think about money a little differently, thank you for spending these minutes with me. And if you'd like more calm, honest conversations about money and financial psychology, consider subscribing to Debt to Wealth. Because the journey from debt to wealth often begins with seeing the system clearly.